Thank you.
Thank you.
All right. Well, thank you, everyone, for being here. Thank you, The Money Show, for the opportunity to present today. And I'm going to pace around. I also only have about 20 minutes to go over our entire outlook, which is almost an impossible task, but I'm going to do my best. I probably will trim some of the slides that I planned to talk about today so I can spend a little bit more time on everyone's favorite topic, politics. For everybody who maybe doesn't know about Fisher Investments, we're managing about $300 billion for individuals and businesses across the entire globe, about 170,000 clients across the entire globe. When we manage portfolios, we construct portfolios using a top-down research process. So rather than just diving straight into stock picking, we're first looking for which haystack has the most needles before trying to find one, right? We're going to start with whether we should be positioned for a bull market or bear market ahead. And by bear market, I mean we're positioning for something that's meaningful downside over enough time to get in and out of the market. For bull markets, we're looking for early, mid, late stage bull market environments. Which one should we be positioned for? Then even after that, we're digging into should we be overweight or underweight certain sectors, countries, styles and sizes, digging into the industry. And then finally, after all of that is decided, we go into the stock selection process where we first try to find stocks that are going to outperform their peers, but also those that are going to fulfill that top-down role we want within portfolios. So without further ado, let me go into our outlook for 2025. And I know after the volatility we just experienced, this is going to make me sound crazy, and all of us crazy, I guess. But by the end of the year, we expect to see a great year for the stock market, up significantly from where we are right now. We are bullish. We think you should still be positioned in equities, positioned for upside ahead. This volatility right now probably mimics something closer to a correction than a bear market. Sure, it might dip below that 20% decline. It's really hard to kind of guess the full magnitude of that, right? But it's going to be short-lived, and we're likely going to recover just as fast as we saw the decline begin. We believe that economic data, fundamentals, earnings are coming in better than investors appreciate right now, and they're going to continue to do so going forward. That'll be especially the case with non-U.S. stocks, European value-oriented stocks, for example, because the expectations for the area of the market is so much lower. There's a very low bar to clear, and that likely leads to a lot of upside surprise going forward throughout this year. We believe that those will be the leaders. European and non-U.S. value-oriented stocks will lead the market on the way up this year. But that's not to mean that U.S. stocks are going to perform poorly. We still think that they'll do okay. Expectations are just much higher for U.S. and tech-oriented stocks. Finally, politics, of course, is a very exciting discussion right now. With politics, of course, there's been a lot of political changes, and we think that the bite is going to be a lot less than a lot of investors are fearing right now. So let's dig in. When we shape our overall outlook, we look at three primary drivers. We look at politics, we look at economic drivers, and we look at sentiment drivers. All three of those, in our view, are just as important as the others. So diving specifically into politics, there's a lot of ways you can slice and dice the influence of politics on the market. And one of the ways that we do that is just by looking at the ebbs and flows of overall political uncertainty throughout the presidential cycle. So we have on this slide divided into 3 calendar years a president's term going back to the 1920s. And you can see in the first 2 years of a president's term that only 60% of the time the markets are positive. You can see just with the results how a little bit more uncertainty, usually maybe one party being a little bit more in favor versus another, coming into a new president's term can weigh on the overall stock market. That's what matters more than which party's in favor. It's just how much uncertainty is created by the political environment. Now, in the second half of the president's term, if you look at both the third year and the fourth year of a president's cycle, that's when you're following midterm elections. We call it the midterm miracle. It's a really strong and powerful period of time for stocks. 92% of the time and 84% of the time, the stock market's positive in the third and fourth year, respectively, because you have either the creation or the persistence of gridlock that leads to a lot of frictions within Congress. Things get widely discussed, widely debated, and watered down before they end up getting passed, if they even do. So it's a good year for stocks as a whole. Now, circling back to this year, we're in the inaugural year. There's a lot more uncertainty that comes with that. But what you can see is historically, there's either going to be some negative returns experienced, or when returns are positive, when you can get over some of that initial inaugural year uncertainty, returns are very positive. The average for positive years in inaugural years is about 25%. And you can see that only one of those periods of time with George Bush's second term was not double-digit growth overall. Now, another reason why we could see a really strong year for the stock market is because that's actually very common. Often I think this shocks investors because you think about the 8 to 10% average annual returns that you might experience. That's not a linear or smooth line, right? But that's often what the industry quotes, just being in equities. But you can see on this slide that 40% of the time, if you just chart all calendar years back to the 1920s, 40% of calendar years have had 20% or more returns. That's strong, and that's very common. Above average returns are better, or more common than just average returns at 8 to 10%. And an important point I also want to make is 74% of the time the stock market's up. Betting against that is betting against gravity for the stock market. So you want to be very, very careful about making something like a bear call. In our view, you shouldn't be doing that unless you have two things. One, you know something others don't, because the market discounts a lot of well-known information. What everybody's focused on, that's already baked into the market. And the second thing is what you know that others don't should be of large scale. I'm talking massive. Something that can wipe several trillions of dollars off of global economic output, several percentage points off of global GDP growth. So with the global economy being about $100 trillion, you're needing something that's several trillions of dollars in scale and size. In our view, there is nothing of that scale right now that causes us to be bearish. We are positioned for a bull market going forward, and we believe that that will be the outcome for this year. So diving into exactly why we think that, as I mentioned, we look at three primary drivers. We think that certainly there's some negatives that are developing within each of those drivers, but on balance, they all support that good continued growth ahead. On the political side, maybe one argument that a lot of folks don't appreciate is that we just came from a super year in terms of uncertainty and in terms of political turnover in 2024. And in 2025, we're going to have a lot less elections. Most of these will be resolved before the first half of the year. Canada's will be resolved before the end of the month, right? And in France, it's TBD still if they're going to actually have any sort of snap election. South Korea's will be in the next 60 days or so. So I think that's one that's maybe underappreciated. But of course, the elephant in the room. Has anybody heard of tariffs? The elephant in the room is what's going on with tariffs. How is that going to impact the stock market going forward and overall economic growth? And we've browsed through all the different consensus models out there and what people are expecting. JP Morgan's talked about a 60% chance of a recession, and we just don't think that we're accurately accounting for the actual impact that gets felt from tariffs. That the impact at face value that gets introduced is not really as much, the impact that actually gets felt is not usually as much as initially addressed. And there's a couple reasons why. Of course, this looks very scary, right? We're talking about up to a 25% effective duty rate coming from about 2%. This is higher than what we saw in the 1930s after Smoot-Hawley that brought it up to about 20% effective tariff rates. This is also an extremely big number in terms of new revenues that we might be bringing in or what's going to be taken in terms of tariffs. We're estimating about $600 to $760 billion is the total first order impact of tariffs right now. That's a big number, right? But that's also not several trillions of dollars, like I said before, something that can actually offset or derail overall global economic output. It's not big enough yet. Now, there's a reason why also even that face value, that big number, is not likely going to be what's felt. For one, companies find ways around tariffs. You saw that in 2018. We traded less with China when we implemented more tariffs on China. But what we did instead was trade a lot more with Southeast Asia and Vietnam. China traded more with them too. What did you just see? Companies just rerouted through other countries. Of course, there's going to be costs that are associated with this, but the total massive, max amount of impact that often gets quoted is not what actually gets felt by the businesses. There's also tariff engineering. If you look at the definition of tariffs, or of goods that are subject to tariffs, they're very specific. And so you can find ways to alter your product slightly in order to not have the same level of tariffs that you might otherwise. Ford did this with their cars. They took out pieces of their vehicles in order to make it not a complete passenger vehicle and shipped it over the border. Nike did this with their shoes. Put a felt layer over it, call it a slipper instead of a shoe, and that's subject to much lower tariffs. So there's a lot of ways you can get around it. Maybe even another example, Delta Airlines. Buy Airbuses, use them overseas for a little while, and bring them overseas back to the US when they're not subject to tariffs. There's a lot of ways that companies get around this. And then on top of that, bureaucracy is probably not big enough to actually effectively, fully encapsulate all of the different tariffs that we want to implement. Back in 2018, when we slapped additional tariffs on China, we estimated the total max amount that would likely be paid, and only 25% that was actually collected in 2018. We are already seeing about the same amount, about 20% of new Chinese tariffs are being collected. So we don't think that the worst case scenario, which is priced in the markets, is likely going to be felt going forward. And on top of that, what we understand is that there are some risks with tariffs, right? So there are 3 scenarios that we're looking for going forward. The first 2 we think are the most likely outcomes. The third would be our bear case. One is that you get court and congressional challenge. You're already starting to see some of that. Back in the 1970s, when Nixon implemented blanket 10% tariffs with a very similar act, he was also challenged by courts, and it was found that it was not within his authority to actually implement those blanket tariffs. They still let him keep it for a little while, though. But that's still something that's very much a likely outcome going forward. There is some congressional resistance as well. That's not likely going to get passed through the House. That's still something to watch. The second scenario is that countries call up the United States and try to negotiate a deal. We're already starting to see that with countries like Vietnam. You already saw some companies like Kohl's or Gap rally about 5-7% yesterday just on the news that there might be a deal made at some point, that people are talking about it. And then finally, the third outcome, which we think is more of the bear case, but least likely in our view, is that a bunch of countries gang up against the United States and they form a massive retaliatory effort that then escalates the scale of this trade war to something that's several trillions of dollars to wipe off that much of global economic output. You saw about a little bit over 20 countries in the 1930s with Smoot-Hawley gang up against the U.S. If you saw a similar environment like that, that would be not a good scenario, especially for U.S. stocks. So that's something we're watching. I know I spent quite a bit of time on politics. I can talk more about that in Q&A if you'd like. For economics, I don't have a slide because I want to spend more time on politics. But on the economic front, we still see fundamentals being pretty strong. Corporate profitability and health is still robust. Companies have good margins. Earnings are coming in better than expected. Consumer health is waning a little bit, or the labor market's also starting to roll over a bit, but it doesn't look recessionary in our view. It still looks like we're coming off of some of the healthiest levels we've ever seen. Inflation, we believe, will remain in check. That doesn't mean that it won't come up a bit, but it won't go back to those 8-9% year-over-year rates of change like what we saw in 2021 and 2022. And lending is important. That's also part of why we like Europe and non-US stocks. Lending is accelerating much more overseas. Accommodative fiscal and monetary policy also being favorable. In the US, it's slowly but surely recovering a bit. Now, sentiment, the third driver that we look at, is also just as important as both of the other ones. This is trying to get a pulse on investor emotion, on investor expectations. And that's an extremely difficult thing to do, but that's something I specialize in myself, is trying to just get specifically out of the market, what are people feeling about it going forward? And of course, you could just qualitatively read the news. You might just qualitatively try to come up with some sort of conclusion, but we try to quantitatively do that. You can look at valuations. Those were pretty elevated coming into this year, right? The premium that folks are willing to pay for a certain area of the market. You can look at flows and positioning, even the correlation of stocks together. One of my favorites, though, is looking at equity issuance trends. And I know this sounds really technical, but this is on this slide the trailing 12-month real change in the total amount of new stocks added into the market net of those being taken out. This is taking into account IPOs, established companies issuing more stock, buybacks, equity conversions, all of it. And you can see that during periods of euphoria where investor expectations build to extremely high levels that usually lead bear markets, in the late 1990s, and even when investor expectations were elevated in 2021 and 2022, there was a big net equity issuance boom. And also in 2008, leading up to that, there was a non-US issuance boom over in China. So one very underappreciated bull case is that we actually have shrinking net equity supply, which means that more stocks are coming off of exchanges, not going back into the exchange. And that's a very positive driver that nobody really talks about. All right, I'm going to have to just wrap up with this slide because I know I talk too much. But I just want to make one point on US versus non-US stocks. We said that we like European stocks because the bar is so low. And this is one of the ways that we measure that. Every year we poll or we gather as many professional forecasters' opinions about where the stock market's going, put it all out on a bell curve. You can see the S&P 500 going into this year, professional forecasters thought would see about 11.7% returns, and that we only expected about 3% for the European stocks in the Euro Stoxx index. Wherever the consensus tends to be with professional forecasts is usually wrong. They tend to be right at the end of the year because they revise their forecasts to follow the market, right? But this just highlights the barbelled sentiment that we think is an opportunity. There's much higher expectations for the US, which we think might be more in line with reality. And there's far lower expectations for non-US and value-oriented stocks where we think we'll likely see some outperformance in leadership next year. With that, I'll go ahead and wrap up so we can have some time for Q&A. I have a couple more slides I could share if anybody would like, but yeah, thank you.